Welcome back to Smart Money. We are in conversation with Ravi Dharamshi, founder and CIO at Valuequest Investment Advisors, and we're discussing all the tools that you need in order to build your portfolio. So, Ravi, everyone keeps talking about the word moat, right? For the uninformed, how does one find the moat of a business?
See, there are few sources of moat that any business has.
First, explain to us what is moat.
Okay, moat is essentially when two companies are competing with each other. One company has an advantage over the other company. What kind of an advantage? Either their cost of production is lower, so they are able to price things lower, or there is a network effect that is taking place. For example, today, if you are on WhatsApp and your friend is on WhatsApp, automatically your entire network has to be on WhatsApp. Or when it started out, the mobile penetration, there was a time when you could call from Reliance to Reliance free. So then that started having network effect. Your exit costs are very high. So for example, today, if you have a particular set-top box in your house, you are a little lethargic. And when I say cost, it doesn't cost you anything. Even after number portability has come into the mobile phone, but not many people are switching from one network to another.
I think is it familiarity bias, right?
Familiarity bias or lethargy that creeps in, or inertia, whatever you call it, that once you are set, you will not change it unless there is a dramatically improved product or solution that is in the market. Then there is in some R&D, innovation-led moat. So all these are the sources of advantages that, for example, for a finance company, it could be the cost of funds. Because of the way your size, because of the way you access the market, you are able to borrow at 1% cheaper than your competitor. That's a huge source of advantage. You can actually deploy that 1% in increasing your moat elsewhere. You will get the best talent, you will have the best technology, your customer's experience will be best, you will be able to offer rates which are lower. So those are the things that companies do to increase their moat. So those are the sources of moat, and honestly, it is more anecdotal, and you will not find it in a research report. You have to experience it yourself. In fact, the best identification of moat is when you experience it yourself. A business which is actually pushing you away, but you are still not able to get away from it, are the best kind of moat.
I'll give you an example.
Hospitals or schools, for example. Even if school says we are going to charge you 10% more, 20% more, 30% more, you will still plead, especially in a place like South Bombay, where please take my child into the school. So that is the power that the business has in terms of charging.
So I have an example here as well.
Sure.
What happened with Vodafone? I was a Vodafone user for the longest time.
True.
Even when they had 10,000 crores of debt and I knew the company was sinking, I refused to change because I was so happy with the service provider.
But this will change when there is true 5G.
Yeah.
And if, for example, now again, we don't own Vodafone, or there is standard disclaimer and everything. But if the entire network moves to 5G, there will be a substantial difference between Vodafone and others. And if Vodafone doesn't have the money to invest for 5G, then they will start witnessing subscribers moving away. So as long as there's a status quo and the two products are exactly the same, then there is a inertia to moving away. But if there is a substantially improved experience, then people will move away.
Now, eventually I did move. I shifted. Just want to make that clarification. But Ravi, I get asked a lot from the younger generation about what are the key books that I can read before I start, my portfolio, start my investment journey. What are the 3 or 4 books that you would recommend? So
before recommending a book, what I would like to say is that, it is not about reading hundreds and hundreds of books. It is about reading the right book and learning the right lessons. And if you reread those 10, 15, 20 books, that is good enough. So if you start with a wrong book, you will actually maybe not like investing at all. So, Security Analysis by Benjamin Graham is a great book, but I don't recommend to a first-time investor, go and read this. Most likely he will get bored of investing and he will never come back to it again. So I usually give the entry-level book that I recommend is Peter Lynch, One Up on Wall Street. That I believe is the best entry-level book because it actually makes you like the subject. And that is where, and then you have to, of course, get into the business history, the equity valuations, all those things come later. One more thing that I highly recommend is a book like, Manias, Panics and Crashes, or Reminiscences of a Stock Operator. Because see, a lot of investing is also about your emotional ride. markets actually, humans are emotional beings, and market going up makes you happy and market going down makes you sad. So, and fear and panic and ultra greed is also part of the cycle. So, if you have read about it, if you have seen others go through that emotional cycle, you will hopefully be in better control of your own emotions. So, when everybody is losing their head, you will keep your own. So, this is, I think that is why a little bit of understanding of the market history is important.
And little bit of your spiritual journey is also important, right?
Absolutely.
Because I think the biggest thing in the market is controlling your fear.
Yes.
And how would you sum up that
Controlling
emotion?
both greed and fear.
Greed
So,
and fear.
let's say this is the line where it's greed and this is fear. You have to ensure markets will transcend greed and will, on the other side create panics. You have to ensure you don't participate in that ultra greed and don't participate in that ultra panic. Those times, even though you're not supposed to time the market, and time in the market is more important than the timing, but what you do at those ultimate greed point and ultimate panic point determines a lot of the outcome. So you have to have that. The most important, organ in a human body that is important for investing is your gut. It is your ability to withstand the market extremes, because more often than not, everybody gets swayed by what's happening in the market. So you have to be able to hold your own, and I think that is why reading about is important, and experiencing that is also important. That is why time, people, those who have 2 decades of experience count a lot, because you would have gone through .com.
Many cycles.
Yeah, many. I mean, crazy kind of manias and panics also. .com bust, global financial crisis, COVID, those kind of things really test your emotions.
Absolutely. And I've myself been in this market for over 15 years, and I've seen the biggest ups and the lowest downs of this market. So I take your point entirely. Ravi, very informative and, educational, last half an hour. So thank you so much for joining us on Smart Money.
Much. My pleasure.
Okay, with that, it was a complete masterclass on how you should start your financial journey. Keep writing to us. We love receiving feedback from you. Until we meet again, happy weekend.